Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. Good to see you.
Hey, man, I love that conversation again in video too. We kind of closed with something that I was hoping we would get to, but I wanted to make its own video. Uh, I've been calling out a couple of things in the real estate game that I think have attracted people as easy money. One of them is Airbnb. I think you can absolutely do short-term rentals right, but I think too many people came to it with the easy button and now have done it wrong, and they're about to be punished. The other one that has been really bothering me for a while is syndications, right? I sold some apartment buildings in late 19 because cap rates were stupid. Then the pandemic, they got stupider, and then rents exploded. And I see just crazy value add, and people got lucky for 2 years. I have seen some people in the real estate game with names they built over years, teaching and whatnot, trying to raise money for doing brand new deals today. And given what I see going on in the multifamily market with rents softening, collections being a problem, they had record occupancy, which has to reverse. And most importantly, actually, there's two. Cap rates have to go up. And then finally, debt is getting more expensive. These people are taking on bridge debt, IO, 1-2 year value add. I think these people are if you're putting in a brand new deal today, at least in most markets, you're going to lose your people's money because it has to regress to the mean. It's just happening across all assets. What do you think?
Well, we're going to find out. The key is, rents. Can you really raise rents? Because that's the only way these deals, are able to get done. A lot of people in the space are just working for fees. They get an acquisition fee, they get a disposition fee. If their investors lose their money, don't make any money, they still get paid coming and going. Yeah. I'm not saying that that's their intention or that's how they start out, but it's a fee-based business. They're money managers, just like a hedge fund or anybody else making money off the fees. And, but a lot of the deals that have been done, people are paying a lot of money, way too much money based on the fundamentals. They're losing money out of the gate in the hopes that rents can go up. And for the last 2 years, that's worked.
It worked. Yeah.
Well,
granted.
There's always a new group coming along that's, raising money, that's willing to pay whatever, because they think they can take these rents that just raised, 30-40% exponentially more. And, who knows? I don't know. We'll see. There's already some markets where rents are backing up.
Yep.
And people are, moving. So we're seeing rent declination in some markets and rent deflation, in some markets. But I'll tell you, a big case study is going to be Grant Cardone. And, he's been on a buying tear, and he pays, he pays high cap rates for the assets he's buying, and he's been able to increase rents in a lot of his properties, and he's focusing more on the higher end properties, which arguably
he pays extremely low cap rates. I don't want anybody to make a comment below.
Low cap rates. So he's paying high values of properties, low cap rates. But they're nicer, higher end properties.
Oh yeah, A plus
properties. Be able to raise rents easier in some higher end properties, but we'll see. And he did that interview with Robert Kiyosaki, and his response was Robert told him he was paying too much money for these properties and it wasn't going to work. And, Grant said, well, I just bought $1 billion worth of real estate. You ain't buying nothing. So, don't tell me who's paying too much. You're not doing any deals. I'm doing deals. And, so the question is, what happens? Because he's doing it all on bridge debt. It's all on bridge debt. And, he's putting, 5 and 10 year bridge debt in place. But, I don't know what his his rate caps look like. I don't know what the threshold is. So the question is, when those rates double, which they have, what does that look like now from a cash flow? And are they still working? And, all that kind of stuff. So those are the types of things you have to look at if you're taking interest only debt. That's what blew up the 2009 and 10 market, was a lot of the interest only debt, and rates went through the roof.
Thank you. Yes. Again, I see so many similarities. I'm glad you and I got here. I see so many similarities in the debt structure of syndication deals that I saw in single family. And unfortunately, the numbers are gargantuan, right? You just can't get away from this. If you're into a 20 million, I see there's a couple of guys who have just supposedly stellar reputations, raising $10-15 million to buy, apartments in Phoenix. And today, buying an apartment today in Phoenix, are you kidding me? That's like the third time that asset's had to trade in the last 5 years. There's silly cap rates, bad assumptions, horrible debt structures. Cap rates are going to go up a point and a half. Interest rates have doubled. Everything regresses to the mean eventually. If record occupancy at 98.7 and it's more like 95, it's going to go the other way. And again, having lived in a family who didn't have enough money, I can promise you rent is not top priority. We will not pay rent so we can buy food. We will not pay rent so we can pay the electricity bill. We will not pay rent so we can pay our car payment to get to work. We will grind that landlord for 60 or 90 days and bolt in the middle of the night. I have lived in an environment where money was not abundant. Rent's
Yeah,
not
or
the top priority.
nowadays you have, avenues that weren't available before, to help mitigate some of that in terms of rent controls and, being able to stay in the property longer than you were in the past, 6 months to a year with moratoriums, things like that. So when you say you wouldn't buy in Arizona, I mean, it just depends on the asset and the area and all that, so the real question is, we are still undersupplied, in the asset class in the country, for apartments and multifamily, as a type of asset within the class of real estate. Right now, we're still undersupplied. So there's not enough units. There's, a lot more demand in certain markets. Now there's other areas where there's tons of vacancy and tons of units, and that's what's happening. We're already seeing it in these markets, Florida, these other areas where people's rents have doubled and they're moving. They're getting out moving, but we'll see if there's other people to replace them, at the prices that are being asked. And so this is the other thing nobody talks about, right? Is demographics. Demographics is huge when you're talking about the economy, recession, growth, and in the rents. I mean, we're an aging population in this country. There's more people aging out and potentially dying than we have coming up. Agreed. So at some point, that's got to rebalance in the real estate supply mechanism. But there's so much pent up demand right now. We're so far behind in all areas, whether it's single family homes or apartments, it's going to take a while for that to play out, but we're already starting to see it. I mean, rents are backing up in Arizona, in, Nevada, in these, southern Sunbelt markets where a lot of people move to from the cities. And, the cities, I think, are losing people too, because just everything that's going on in the cities are so unsafe, in a lot of areas right now.
Totally agree. If I was looking at a new syndication deal, and again, this isn't a blanket statement, it never is. I've just seen more, because again, I'm an accredited investor. I'm on lots of lists on purpose because I like to see this stuff. I see unrealistic cap rate assumptions. I see unrealistic rent growth assumptions. I see unrealistic vacancy. Again, I own this stuff. So I say this from experience. I'm not guessing. And then I see the one that really gets me is unrealistic refi assumptions. Like they're assuming a interest rate. Some of these debts are 12 months with an option for 12 more. I do not want to be refining in 12 months.
Well, the thing is, just like before 2008 and 9, all of us, that has all worked for the last, 15 years since 08, 09, since the market rebounded, and more particularly in the last 5 to 7 years, that business model has worked in the last 2 years exponentially. I mean, people have been able to raise rents like I would have never thought, you could do some of the stuff that's been going on. Nobody did,
No, agreed. But this doesn't go forever.
Because of the pressure that was put on the markets from the pandemic and there's just no inventory out there all across the board. So again, that is not sustainable, obviously.
Agreed.
And we're already starting to see pushback. The question is how fast, how far, and in what markets. And just like anything, you buy at the peak of the markets, when we were talking about it in all asset classes, at the end of last year, you're gonna unwind and you're gonna revert to the mean, like you said. Reversion to the mean goes both ways. Fighting the Fed, don't fight the Fed goes both ways. And that's the price you pay. Unfortunately, for investors, the ones that pay the price are the investors. So the syndicators, agreed. They got their fees, they're going to get out of the assets. They're non-recourse. It's the investors and the equity, that gets wiped out in those situations. And, there are deals out there I'm seeing that are, under pressure, at risk. And, we'll see how these things go. And who the big names are that have been doing it. And it's, they're going to get tested if they're not already, being tested.
No, it's again, I've been in this game a long time. It happens every cycle. Something gets hot. Something is assumed to be the easy button. It works for a little while. Then everybody comes and it blows up. The syndication business has been a problem since 19. I was speaking in front of groups around the country and everybody was a syndicator. You got bailed out by a once in a lifetime pandemic that took cap rates abnormally low, that took rates abnormally low, that forced occupancy, that gave you payment from the government. It was just the perfect storm that made you look like a genius. Trust me when I say you're not a good operator. There's a lot of people that crushed it for 2 years that think they walk on water, and you're going to get hurt. And more importantly, you're going to lose your reputation, but you are going to lose millions of dollars from your limited partners. It's
Well, so that's not everybody. There are good operators. There
I
are
didn't
people
say
that know the
everybody.
business, know what they're doing, and understand. And syndication has been around forever. I mean,
Mhm.
Sam Zell invented the business, and he's
He
been
did.
one of the most successful investors of all time. But he also exited. So
Yeah, he's not buying right now.
yeah, you got to sell at the right time. But the ones that just blindly go into it and just think rents go up forever, values go up forever, rates stay low forever, and cap rates always go down. There's going to be some damage in certain markets there. That's why I say there are still deals being made. There are still deals that'll work. You just really need to understand
Be very
where
careful.
are rates right now, where are they headed potentially, and the expectation that the Fed's going to pivot and rates are just going to come right back down. These things can take a while. These types of situations. I mean, it took 10 years for the market to correct and unwind after 2008 and 9, and it took 2 or 3 years to get there.
Mhm.
Then it took 10 years to unwind from the bottom.
Yeah.
So we're just now at the top of this. We've only been in this, really about, it started, October, November, December. So 9 months in, to this correction,
Mhm.
getting into the, we're in a bear market, in all
Mhm.
assets. Real estate doesn't look like a bear market just because of the anomaly of the pandemic and the demand out there, for all types of real estate. But office, is in big trouble in San Francisco. I mean,
Big time.
vacancy
40
rates here are just unreal.
Yeah, I heard we're heading to 40% vacancy. They're going to get DSCR calls. There going to be a lot of office buildings owned by banks here shortly.
Yeah, and they just convert them to multifamily, and then you have more. So we'll see what happens in that market. But yeah, I mean, there are some deals that are already blowing up. They have blown up, but again, this environment's different. So the lenders, there's different options, different choices. It depends on whether they're Freddie Fannie or whether they're MBS or whatever the debt is on the property. In terms of what the opportunities are. But at the end of the day, the equity is the first thing that gets wiped out, as the property starts losing, and, you can raise rents to a point. And I mean, everybody was a genius the last few years. The markets and every asset would just straight up, just bull market. So, anybody who was in the market buying made money, but like you said, the last couple of years have been kind of an anomaly from where the rates, went. I mean, unbelievable how low the rates, were dropped and how much liquidity was pumped in the market. I mean, just mind-boggling. When you look at the charts of any asset, in the last 2 years, it's straight up parabolic.
Mhm.
And there's only one way that ends up,
Mhm.
but it's temporary, and then you go through the whole cycle again. And that's why I say, bad times never last, good times never last. I mean, it's peaks and valleys and cycles. And this one just happens to be the biggest bubble we've ever seen in the history. And I'll tell you, somebody who's been talking about it longer than me is Jeremy Grantham.
Mhm.
And,
Yeah, I've listened to him. Yeah.
yeah, very smart guy, been through it all, along. He's like, you haven't even seen the scratch of the surface yet.
Yeah. Jeremy's basically saying lots of pain ahead.
Yeah. And, he'll say the only one that really, from a Federal Reserve standpoint, actually knew what was going on ever has been Paul Volcker. He said nobody else has gotten it right since Paul Volcker. And, I think he's, on point there.
Yeah. Pretty crazy. This has been a fun conversation. I think real estate is simple, but not easy. Hopefully I'm saying that right. You can make a lot of money in real estate, but it takes work. It takes learning your craft. It takes knowing what you're doing. It takes research, consistency, execution. I get nervous when all the newbies show up and just throw money at it. That doesn't end well. And I've seen too many people throw money at Airbnb, throw money at syndications, and that doesn't end well. So I'm nervous for them.
Well, it's not just there. Stocks,
Oh, sure.
crypto, there's a lot of people that are in the game, in the market now, that have never gone through a global macroeconomic bear cycle, bear market downturn like we're in right now. Haven't seen it.
No,
I didn't either before 2008, 9.
Yeah.
I saw a couple little hiccups, like when I bought my first house, the market was a little sluggish, but I wasn't in it.
Yeah.
And for me, my own personal experience, everything was going straight up. And I used to be one of those guys that said, real estate's never going to come down. They ain't getting any more of it. It's always going to be worth more until it's not.
Yeah.
I just didn't know any better. And all the old timers were telling me, hey, back in the 70s, back in the 90s.
Yeah, let me tell you.
Or not the 90s, but, because I caught it at the, early 90s, late 80s, early 90s, the SNL crisis and all that. They're like, it shuts off like a faucet and it doesn't always go up forever. And, we all learned that lesson the hard way. But, when you're in it, you don't know anything different because you haven't been through anything different. You have to go through these cycles to understand how to manage risk and hedge against the downside, and realize, they say easy come, easy go for a reason.
Yeah.
There's a reason that's a saying.
Exactly. Well, we've been through it, wow, over 40, almost 50 years combined together. We're trying to help people see it. Greg, where can people find you?
Yeah, gregdickerson.com. That's where all my info lives. Go check it out.
Thank you, buddy.